Welcome to this video. Today we're going to talk about Beyond Meat. So after massive dilution and collapsing sales, Beyond Meat went all the way to $1.60, collapsing over 75% from the previous high of $7.50. And there are now kind of two camps. One group is saying, hey, this is going to be like BBBY, Bed Bath & Beyond, and this is going to go bankrupt. And the other side say, no, Beyond Meat is going to the moon. It's going to be like Carvana. It's going to be the greatest comeback history ever. So which side is right? Is this the stock market bottom? In this deep dive stock analysis video, we are going to find the truth. So let's not waste any more time and let's get started. Beyond Meat is a company that's specialized in plant-based meat. They make vegetarian food that tastes like real meat. We know that Beyond Meat is financially weak. They have bad cash to debt ratio and are not profitable. They're losing money. But in order to know whether this company can turn around, we need to know if there's still demand for plant-based meat. So in this article, we can read that the plant-based meat market size was valued at $16.69 billion in 2024. Looking forward, EMARC Group estimates the market to reach $100.31 billion by 2033, exhibiting a compounded annual growth rate of 21.92%. So that is pretty big. So the overall market is growing. So the CAGR is over 20% in the industry, and Beyond Meat is the only public company that is in the plant-based meat industry. So the demand in this industry is booming. But why is Beyond Meat losing money? Let's look at this income statement breakdown. We can see that the revenue is $326.5 million and the gross profit is only 12%. So only $41 million is gross profit. From this $41 million, they see that on the total operating expense is $197 million. So that's more than the gross profit. So that's why they are in debt. It costs more, they lose more money than they're making. And then you also have operating income, pre-tax, net income. And you can see that the net income is minus 160 million. So they're essentially losing money. But the biggest chunk of revenue goes to COGS. So what is COGS? So COGS basically means cost of goods sold. And in this case, it refers to the direct costs of making and delivering Beyond Meat's products. And this consists of first, the raw ingredients. Pea protein, canola oil, coconut oil and flavorings, they cost a lot of money. Apparently, it's quite expensive. So in order to be more efficient, they could do in larger scale, for example. The second thing is manufacturing and packaging, cost money. Then you have logistics, and eventually you have factory labor. Employees directly involved in making the products. Here they could also implement like maybe robotics, AI, and hire less people, things like that to become more efficient. So there are things they can cut money on to lower the cost of goods sold. In short, this will lead to a higher gross profit, and that will lead to a higher net income, and that will increase the intrinsic value of the stock, which will lead to higher stock prices. So in this article, we can read that Beyond CEO Ethan Brown here tells Fast Company about his new plan to compete for protein-obsessed customers and his fanatical strategy to return the company to its former heights as a stock market darling. So his plan to turn around this company is essentially expanding the product line. Instead of only having plant-based meat, they are now making plant-based foods in general that have high proteins, and it's not just mimicking animal proteins. This could reduce the cost of goods sold, which we talked about before, and that can lead to higher profit margins and maybe a positive net income in the future. They don't want to be called fake meat anymore, have that bad reputation, and they want to be like a company that has vegetarian, healthy food. And of course, they will keep their burgers and their chicken nuggets, but they will expand their product line. Risk it all in one trade. Go big or go home. Warren Buffett. This is obviously a joke. I thought it was funny. I saw it on Wall Street Bets And this comes to my next point, and that is that Beyond Meat is a meme stock. And a meme stock has mass psychology behind it, like GameStop. GameStop was a losing company, but because also of the mass psychology, that's also what kept the price much higher than its true value. And this can also happen for Beyond Meat. So the big question is, can Beyond Meat recover and become a success story like Carvana? Carvana is essentially an e-commerce platform that specializes in buying and selling used cars. So a few years ago, Carvana was in a similar situation with a lot of financial trouble. And you can see that it went from here all the way to $4, and it went down 99%, similar to Beyond Meat. And it didn't go bankrupt. So from like $4, it recovered, and it went all the way to $400, like at the peak. So it went from $4 to $400, which is 100 times your money, which is insane. But of course, you also have BBBY, which was a company that went completely bankrupt. Now someone bought it over and used the same name, but the original investors lost everything. So what's going to happen? I'm bullish on Beyond Meat. I believe it can recover, not as much as Carvana because the shares are heavily diluted. So I don't think that we can go to all-time highs, but I think we can go to halfway to like $50. I want to share with you how I personally invest in speculative meme stocks. And this is like a portfolio example. I always have a cash reserve, so I'm always capable of buying low and selling high. And it also decreases the volatility of my portfolio. I have always an S&P 500 position, and I have many great companies like Google, Amazon, Nvidia, Tesla, Salesforce, Microsoft, with a wide economic moat that will do well over time. I allocated 2% of my portfolio to Beyond Meat. That's my cost price. And if Beyond Meat goes to the moon, 2% can easily become 10% of my whole portfolio. So this can become 10% of as a position, but I've only paid like 2%. That's my cost basis. And that's very important because if you go all in Beyond Meat, then it's high risk, high reward. You either lose everything or you go super rich. And if you only risk like 2%, you either lose 2%, so your portfolio drops by 2%, or if it recovers all the way, you can increase your portfolio by like 50%, because this Beyond Meat position can be like a massive size of your portfolio then, if it grows by itself. But the cost basis is 2%. I will not buy more shares than 2% of the portfolio. And now it becomes a low risk, high reward. And that's what we're all looking for as investors. We're now looking on TradingView, and this is a forecast of analysts. And they say the worst case scenario after 1 year is 80 cents. So we're now looking at the stock price of Beyond Meat on TradingView. And we see it's now trading at $1.58. And from previous high, it went from $7.60 to $1.58, almost an 80% decline. But I think it will go maximum to $1, then it will bounce from $1 and we go all the way up. Earnings are coming soon. I will talk in my next video more about the upcoming earnings and what we can expect. I hope you learned something. Don't forget to like and subscribe for more videos, and I will see you in the next video.